What's going on, everybody? Welcome back to another video in the Day Trading Institution. So this video is probably gonna be the most important video in the entire course. So today we're gonna be talking about risk management. Now, risk management is our job as a trader, right? Instead of calling yourself a trader, learn to call yourself a risk manager. Now, really what we're going to be talking about is risk percentage. We're going to be talking about drawdown, risk versus reward, and win rate. All of these together make up risk management, right? I don't know why it says candlesticks here, right? Now, what is our job as traders? Our job as a trader is simply to determine the probability behind a direction in the market and manage our risk. That is our simple role as a trader, right? Once you actually have your trading set up, you know where you're going to get in when you have your trading signal. You know where you're going to get out if you're right, and you know where you're going to get out if you're wrong. All you simply have to do is manage your risk. Now, risk management, again, is so important because there's going to be losing streaks in the market. And I'm not talking about 2 or 3 trades and then you're going to start winning again. Losing streaks could come in various different forms. You can have a losing month. You can have a break-even month. You can even have a losing quarter. The only thing that's going to bring you back from that losing streak is managing your risk properly. Now, how much should you risk per trade? This is a question I get asked all the time. And really, it just depends. It's very situational. How much a trader is going to risk per trade ultimately is up to the trader. We want to always follow a strict risk management system and focus on the probability side of trading to ensure longevity. What's going to happen when you first start trading is typically you're going to be over leveraging, right? And yes, while over leveraging, you can make a lot of money very quickly. You can also blow up your account very quickly, because what starts to happen is you take a trade or two that are losing and you double up each time your lot size to try and make that loss back plus more. But once you actually start losing, your confidence starts to go down subconsciously. And at the same time that that's happening, you are not going to be able to perform as well as you would have previously without taking those losses. Trading your system with as much accuracy and precision as possible is going to become more and more difficult with the amount of losses, right? Now, if you take a really big loss, your confidence is going to be to the floor because you're like, oh man, I just lost all this money and I'm going to try and make it back, when really your losses should be as controlled as possible. The goal of trading is to lose as small as you possibly can and win as much as and make as much as you possibly could for each win. Again, you want to lose small and win big. And that concept is all based off of risk to reward ratio. Now, right, this is how I determine my risk per trade. If I see maybe I'm taking a type B setup where I don't have as many confirmations, I may take a low risk entry, anywhere between 1 to 1.5%, right? Now, every setup is going to be different. The more confirmations I typically have on a setup, right, the higher the risk I'll typically go. So if I see a nice, clean type A setup where I have maybe 4 confirmations, I'll take a risk of about 2 to 3% on my account. Now, if I see I have a really high probability setup and I'm trading at a really good level that, again, the probability really is in my favor, sometimes I'll take a trade anywhere between 4 to 5% risk. It really depends. But really, you want to stick to a risk and be consistent with that risk as much as you possibly can. Now, let's put something else into perspective. If you start risking 5% a trade, right, and you take 2 trades that are losses, you're down 10%. You're going to have to make roughly like 12, 13% just to break even from those 10%. Because remember, if you take a loss of $5,000 on a $100,000 account, you're no longer risking $5,000. You're risking maybe $4,500 now, because now you're only risking 5% of $90,000. Your risk also goes down as well, right? We'll go over that on the risk management chart in a little bit. But just keep in mind, you have to set yourself up for a losing streak, right? And keep all this in mind. Now, if we lose 10 trades in a row at a 1% risk, we're down 10%. Versus if we lose 10 trades in a row at a 5% risk, you're down 50%. It is going to be so hard for you to make back those 50%, right? So I like to have a nice median. Typically, every single trade I'll risk roughly 2%. So it's 2% is comfortable for me in terms of how much I'm risking, because you can make a lot of money risking only 2%. You know, I'm risking 2% to gain anywhere between 4 to 8% a trade, right? Which if I make 8% on 2 trades back to back, I've just roughly made like 16%, which is amazing. 16% on a $100,000 account is $16,000. And that is my favorite number to risk, 2%. That is my personal favorite number to risk. Sometimes I'll risk more, sometimes I'll risk 3, 4%. Rarely ever do I risk 5%. Rarely. And you just have to find what's comfortable for you ultimately at the end of the day, right? As a beginner, I recommend only risking 1 to 1.5%. Just do low risk, just so you can get the feeling of what trading actually is. Now, every setup will be situational. The trader should have a base risk percentage per trade. Exactly what I went over last time. Typically, I always risk 2% on a trade. Sometimes I'll risk less, sometimes I'll risk a little bit more, but typically I'm always risking around 2% per trade. Now, let's say the trader decides to take a 2% risk of his account per trade and he's trading with $10,000. This means that he will be risking no more than $200 per trade. So all that simply means is if your stop loss gets hit, you're going to lose $200, right? Now let's take a look of this chart, right? So number of trades is how many trades we're going to be losing in a row, and then we're going to look at the risk percentage of how much we're risking. Now typically I'll never risk 10 or 20% a trade. Well, typically I'll almost never risk 10 or 20% a trade unless I'm doing like a crazy challenge, right? But anyways, let's look at how much it would take you to come back from these losses, right? We're simply looking at a losing streak here, which typically you're never really going to lose 20 trades in a row. What could happen is you lose maybe 4 or 5 trades in a row, you win 2, and then lose another 4 or 5 in a row. That's how losing streaks typically work. You just enter a quarter or a month where you're just losing. Your system isn't working as profitably as it normally does, and that's gonna happen. That's just part of trading, right? You could be down 27%, but know that within the next few weeks, you're gonna make that loss back plus way more. And you have to instill that in your head. Losing is part of the game, right? We're gonna have losing streaks. It's unavoidable. Losing streaks come in different forms, right? Like I said previously, right? You could be losing maybe 3 trades in a row, winning 1, losing another 3, winning 2, losing another 3 or 4, right? That's going to be considered a losing streak because you're losing more than you're winning. Now, just because you enter a losing streak doesn't mean you're going to have straight losses. Sometimes you may actually win a trade or 2, but then start losing again. And, you know, that could last for a period of a month, 2 months. It just depends on the market conditions and how you're doing psychologically, right? So let's take a look at a 1% risk. So a 1% risk of our initial balance being $10,000 is going to be $100 per trade. If we lose 20 trades in a row, you only lose 18% in total, because remember, when you start losing, you're only risking 1% of your account balance. So instead of risking $100 here because we've already taken a loss, we're risking $990. Then we're risking $99, and we're risking $98, and we're risking $97, and we're risking $96. So it incrementally starts to get lower and lower, right? And notice that even if you lose 20 trades in a row and you don't win a single trade, because remember, right, we look for risk to reward, meaning that our next winning trade should make us at least 2 or 3 losses back, right? So if you lose straight 20 trades in a row, you're only going to be down 18% or $1,800, which you could make all of that back just by winning 10 trades in a row at a 2-to-1 risk to reward ratio, meaning that you're looking to gain 2 times what you're risking. So essentially, if we're risking $81 on a specific trade, we're looking to gain roughly $162 on that trade because we're looking to make double what we're risking. And then it starts to compound again. So just let's take a look at this example, right? If we're risking 1% per trade, we're going to be down 18%, losing 20 trades in a row. Now put yourself in a mental space, right? You've only lost 20 trades in a row and you're down 18%. It is not going to be that hard for you to come back from that. Like I said, again, you could almost break even or probably make even money on top of that just by making 2 times your risk. It's pretty simple. Now, if you're risking 2% a trade, your drawdown is going to be a lot bigger, obviously. Now, instead of being at an $8,000 balance, losing 20 trades in a row, you're down $6,000. You're almost down 50% here. Now, if we lose at a 5% risk per trade, you're down 64%. That is going to be so much harder for you to come back from making those 64% because you're down more than 50% of your initial capital. So just for you to break even, you're going to have to practically make almost 100% of these $6,000 just for you to even be in profit. To make 100% is going to be very, very, very difficult in a short amount of time, and it's going to take you a lot longer to recover, right? Versus only trying to make 20%. Here you have to make back 100%, and we're only increasing this by 4% risk per trade, right? And again, you're gonna have losing streaks in the market, especially as a beginner. So you really want to try and focus on just risking 1%. Later on, when you become more skilled and more experienced, you could start risking a little bit more and more, right? And again, there's going to be a lot of things that you see on social media. Don't focus on flipping accounts, because what happens when you start to look to actually flip accounts instead of a percentage gain and look to actually manage more capital in the future, you're going to get stuck in a cycle where, let's say you start with a $5,000 balance. Give me 1 second, guys. The guard dogs are going crazy. Like I was saying, guys, I apologize for that. But what's going to happen is that you're going to get stuck in this cycle. Let's say you deposit $5,000 and you're risking 10% per trade trying to flip your account. Let's say you win the first few trades, right? What's going to happen is that you're going to be extremely overconfident and you're going to start risking more and more until you actually hit a losing streak where you lose 50% of the account, 60% of the account, and you only have $2,500 in your trading account. Right? Let's say you make back some of that loss, but ultimately what's going to happen is you're going to blow up your account because, again, a losing streak, it only takes a few trades to blow up your account with that high of risk. As you can see here, at a 20% risk, you blow up your trades at 20 losing trades in a row, which, again, typically you're not going to see 20 losing trades in a row. What you'll see is 5 losing trades, then maybe 2 or 3 winners, then another 5 losing trades, and by then you're down a lot. And again, what's going to happen is that your confidence is going to hit the floor and you're going to no longer be able to trade with accuracy and precision because you have this big pile of losses in your subconscious, right? So instead of just thinking about the next trade, you're thinking about all the previous trades that you've just lost. And then when you blow your account, you're going to be discouraged. You're going to feel maybe even depressed, right? And you're just going to be thinking about all those losses. And what's going to happen typically is you're going to be like, well, you know, I saw this guy do 5K to 25K, right? And some people even try and be like, oh, you know, if I can just flip 5K to 25K, then I'm just going to practice real risk management then and there, right? And you deposit another $5,000, you try and flip it, you blow it again, and by the time you looked at it, you've blown 2 $5,000 accounts. You've blown $10,000. And you could have just been practicing a real risk management system to begin with, right? Now, again, when you become a skillful trader, later on, you're going to make the money. Don't worry about flipping accounts. The money will come. Worst case scenario, if you are somebody that's a little bit undercapitalized, just go with a funded company. If you can make 10% in a month, right? Just go trade with a funded company. Get an $100,000 account, a $200,000 account, make 10%. And if you keep 10%, if you keep 80% of the profits, like on FMS, we offer an 80% profit split. If you can keep 80% of those profits, you make 10%, you just made yourself $8,000. Do that for 2 or 3 months, and your $8,000 have turned into $24,000, which you can now trade on and risk 2% a trade and make substantial amount of money. Ultimately, it's up to you as a trader to do that. But again, you don't want to be stuck in the cycle. And this is what I'm talking about from experience, because when I first started trading, I was stuck in a cycle of just losing and losing and losing, blowing account after account after account after account. Now I'm telling you guys this so you avoid making the same mistakes that I did. That's why I'm here. I'm here to help you guys avoid the same mistakes that I did, so you can find that trading curve and that learning curve that everyone desires, where it's not such a rough road, even though it's going to be very difficult regardless. I'm just trying to make the road as smooth as I possibly can for you. Now, some people are going to be like, yeah, you know, whatever, I'm just going to try and experience it and do it anyways. Ultimately, that's up to you. I'm telling you that flipping accounts in the long term does not work, so we want to focus on a real risk management system. If you genuinely and you truly want to become a profitable trader in the long term, you have to be patient with it. You have to learn how to grow your account slowly, because once you grow your account slowly, the psychological barriers are a little bit more easier to handle versus, you know, you trading $10,000 in your account, now having, you know, let's just say you go full margin and you make $20,000-$30,000, right? You're no longer trading those same 10 grand, you're trading 30 grand. What's going to happen is you've never seen this much money before, and you're going to enter even bigger lot sizes. And typically what's going to happen is you're going to end up blowing your account at some point. Yes, I know traders who they flipped $100,000 into $1 million, but ultimately ended up blowing those $1 million, right? It's happened, and you don't want to be one of those situations, right? I've done it before too. I've turned $15,000 into over 150 grand. And then I took a huge loss of 100 grand. Then I had $50,000 left over to play with. I took out my $15,000, had $35,000. And at that point in time, I told myself, this is when I actually need to focus on real risk management. And that was a long time ago. I've gone through a lot of ups and downs in trading, and I'm here to help you guys avoid as many downs as possible and show you the real method of how to actually make trading a profitable business. Right? No business is really making thousands of percent a year. Trading is a little bit different, right? You can make a lot of money, yes, but you need to be psychologically stable, and you're only going to be psychologically stable by focusing on risking 1 to 3% per trade. Even if you're risking 3% a trade, right? You lose 3 trades in a row, you're down 9%. Being down $9,000 in 3 trades is a lot of money in a very short period of time. But again, some traders have a higher risk tolerance, so they can deal with bigger drawdowns, right? Really, you never want to see a drawdown over 40%, because it's going to be so hard for you to make all that money back. Anyways, if you guys want, you could screenshot this just to keep in mind what risk management is like. Again, you really only want to risk 1 to 2%, especially in the beginning, because coming back from a 33% loss is not bad at all. It's very doable. Last year, I actually started the year really great, made 10% on January, and then 20% in February, then lost 15% the month after, made all that back the following month, and then in the summer, I was down a total of 44%. August, I made those 44% back, and then September, I was up an extra 10%. So there's going to be times in your trading where you're going to have losing streaks. For me personally, my losing streaks come in the summer and in the holidays. So this holidays, I decided to take trading off and to come back in January when the markets have more volume. Every trader is going to have different losing streaks at different times. Just keep that in mind, guys. Now, remember, the lower the risk, the easier it will be to recover from a losing streak. Now let's cover risk to reward, which is something that's super important. So here we have a chart of risk to reward. So everything in green means the trader is profitable. Everything in white is going to be around break even. And then everything in red is going to be a loss, right? So notice how you don't have to win 100% of the time to be profitable, right? If you're trading at a 5-to-1 risk to reward ratio, meaning that every single trade you're risking $100 to make $500, and you only win 1 out of 10 trades, you're going to be break even. So even if you only win 40% of your trades, meaning that out of 10 trades, you lose 6 and win 4, it's only going to take you a 2-to-1 risk to reward ratio to be profitable, meaning that you only have to risk $100 to make $200 and win only 40% of the time. I just want you guys to keep in mind, right? The bigger the risk to reward ratio, the better, because remember, we're paying for our next trades, right? We don't want one trade to wipe out our profits from the previous trade, let alone one trade to wipe out the profits from the last 2 or 3 trades, right? We want one trade to pay for our next 5 trades, meaning that we have to lose 5 trades in a row to break even from that one winning trade. Typically, what's going to happen is that when you're actually trading and you look for higher risk to reward ratio trades, you're going to start losing more trades because you're looking for a lot bigger moves in the market, right? Really big risk to reward ratio trades don't happen that often. You're not going to get, a 5-to-1 risk to reward ratio trade every single winning day. It's just not going to happen. So you're going to lose more trades in turn. It's kind of like a scale where if you want a bigger risk to reward ratio, your win rate drops, where your risk to reward ratio significantly increases. If you want a bigger win rate, your risk to reward ratio is going to decrease, but your win rate is going to increase. You as a trader need to find that balance where you like. Me personally, I don't mind winning only 45 to 50% of the time, as long as my trades are paid for by one trade, right? Typically, depending on the market conditions, me as a trader, I have a win rate of anywhere between 50 to 70% depending on the market conditions and how I'm trading during those conditions. Sometimes I'll look for shorter term trades where I'm only getting 2 or 3 times my risk. Sometimes I'll look for bigger swing trades. Typically when January, February, March come around, when it's quarter 1 of the year, I'm looking for bigger swing trades. So my risk reward rate, my win rate is a little bit less, but I'm making so much more money because, again, if I'm risking $5,000, I'm making $25,000, $30,000 a trade. And it all depends on the trader. So notice how, again, you could be winning 30% of the time, meaning you only win 3 out of 10 trades, but you're profitable at a 3-to-1 risk to reward ratio. Now, you as a trader have to stick to your risk to reward ratios as best as you possibly could, right? So ultimately, it's going to come down to what you're comfortable with. Some people need to win more trades for them to be successful and feel that confidence, because again, psychologically, it's going to be very hard for you to be okay and understanding with the fact that, yeah, I'm losing more trades than I make, but in the long term, I'm profitable, which is more important to me. That's fine. You as a trader have to find your balance. It's all about balance at the end of the day, right? Now, there's a few more topics I could touch up on, but really this is a simple concept. Now, when you're actually scalping, typically scalpers have a very low risk reward ratio, right? It's about a 1-to-1, but their win rate is a lot higher. Now, when you're day trading, your risk reward ratio does take a little bit of a hit. Day traders typically have a win rate of anywhere between 50 to 70%, 70% on the really high end, where you're taking very little trades. You're really only focusing on those perfect setups, and you're not going to get there right away. As a day trader, if you want that big win rate and that big risk to reward ratio, you're not going to be taking as many trades as a normal trader, where they're really focusing on taking intraday positions, right? You're really focusing only on a very few amount of trades, which you're only going to be able to accomplish by maturing as a trader overall. Now, when it comes to swing traders are the ones who have the lower risk to reward, or the lower win rate, typically anywhere between 30 to 50%. I haven't really met too many traders that have a win ratio of 20 to 10%. I have met a few traders who are profitable at a 30% risk to reward ratio, and that's because they focus on, or at a 30% win rate, because that's because they simply focus on that 3-to-1, 3.5, even sometimes 4 and 5 to 1 risk to reward ratios. Again, this does not matter. The amount of trades you win does not matter. Let me kind of get something out into perspective for you guys, right? So I'm going to bring up my painting software here. So let's say as a trader, you lose, this is typically how your risk to reward ratio works. You lose $100. You lose $100. You lose $100. You're down $300. And then here, you actually make $500, making back those $300 plus more. Then let's just say you take another loss, $100. Then you make another $500, right? Giving you a total profit of about $700 in total, $600 in total. Why? Here we lost 100, here we lost 100, here we lost 100. Here in total we're down $300. Then here we make $500, giving us a net of $200, right? Then here we lose another trade, $100, so now we're only a net profit of $100, right? Now here we make another $500, giving us a total net of about $600. And let's just say you're a day trader. This is 1 day, 2 day, 3 day, 4 day, 5 day, 6 days of trading. You're up $600. Now let's just say we make another $300, because you're not always going to get the same risk reward ratio every single trade. Now you're up I don't know why I had a brain fart there. Now you're up $900 net in the span of 7 trades. And typically this is what we want to focus on. We want to focus on risk reward ratio. We want to focus on big winners and keeping our losers as small as possible. Now, why trading is so hard in the beginning is because you're going to have to learn how to stick to your stop loss. Because there's even times as a trader where you're like, yeah, you know, I'm comfortable losing $100, but once a trade actually goes into your, once the trade actually goes negative and you're down $25, you're like, you know what, I'm going to cut the position here and look to get back in. And if you do that 3, 4, 5 times, instead of losing an original $100, you lost $125, right? And you have to be able to avoid that as best as possible. Because if you see that the market is trending bullish and you're like, hey, I'm going to buy at this previous structure level, and you have your price action signal, if you buy right here and you say your stop loss is valid down here, because if the trade is wrong and you're wrong in the direction, right, then this is where you want to get out. And then this is where I'm going to get out up here if I'm right. Notice how big our reward is versus, let's make that green again, how small our stop loss is. This is typically double the size of our stop loss, our reward. But some traders, especially in the beginning, need to learn that the trade is still valid and can fluctuate all around here until your stop loss gets hit, where you'll do a reanalyzation of the market the following day, or maybe look for a re-entry later on, and you're going to learn that you need to stick to your stop loss as best as possible. Because if, let's just say price is fluctuating, here's your entry, here's your stop loss. Let's make your entry green, right, and your stop loss red. Price can fluctuate all throughout your entry and your stop loss. And if you decide to cut your trade here and get back in again here, and you cut your trade here, get back in again here, and you cut your trade here, and you get back in again here, you've just taken $100 loss just by not being patient and sitting on your hands and not allowing the trade room to breathe. You have to understand that you need to give the trade room to breathe as well. I call this paper cutting your account, which is a mistake that traders can do at the beginning. And if you're over leveraging and you're over trading and you're paper cutting your account, you're going to destroy your account. So hopefully you guys understand the risk reward tool. Again, a 1-to-1 risk reward ratio. I don't take trades at a 1-to-1 risk reward ratio. If you're a scalper, then it's acceptable, but you should really only focus on a 2-to-1 risk reward ratio and plus. Why? Because you can win 40% of the time at a 2-to-1 risk reward ratio and be profitable. Very simple, right? So hopefully you guys did understand this risk management system. In the next video, what we're going to be covering is actually applying risk management to the actual chart.